If you saved $100,000 in the year 2000 and left it in cash, that money today would have the purchasing power of roughly $55,000 to $60,000. That is not market risk. That is currency erosion. Since 2020 alone, cumulative inflation in the United States has exceeded 20%. That means everyday expenses such as housing, insurance, food, and healthcare have permanently reset to higher levels. The dollar is still the world's primary reserve currency. It is still widely trusted, but purchasing power and reserve status are two different things. So the real question is not whether the dollar is collapsing. The real question is this: is the dollar steadily losing value over time? And if it is, how should serious investors respond? Before we examine the data in detail, it is important to understand the framework behind our analysis.
At ATN, we help everyday investors access private, institutional-style trading systems that used to be reserved for hedge funds and ultra-high net worth individuals. The model itself is hybrid by design. Automation handles execution and monitoring around the clock, enforcing rules consistently and without emotion. Experienced professionals oversee strategy, risk management, and changing market conditions. Our clients aren't looking for excitement. They're looking for consistency, transparency, and peace of mind. Our clients want growth, but not at the expense of control. ATN was built on the idea that real automated income should simplify your life, not add more stress to it. If you agree with that and are interested in learning more, there should be a link to speak to us in the description of this video.
Now, let us begin with how the dollar's value is actually measured. If you look at the US dollar index, which compares the dollar to other major currencies, the dollar has remained relatively strong in recent years. However, that only measures the dollar against other currencies. It does not measure purchasing power. According to official inflation data, the US dollar has lost over 85% of its purchasing power since 1971, when the gold standard ended. Since 2000, cumulative inflation has reduced purchasing power by approximately 45%. Since 2020 alone, inflation has been among the highest in 4 decades, peaking above 9% in 2022 before moderating. Even at 3% annual inflation, money loses roughly half its purchasing power in about 24 years. That is the silent effect of compounding inflation. This does not mean the dollar is collapsing. It means that holding large amounts of idle cash long-term guarantees gradual erosion. There are structural reasons behind dollar devaluation over time. First, money supply expansion. During economic crises, central banks inject liquidity into the system to stabilize markets. Between 2020 and 2022, the broad money supply increased dramatically in response to pandemic stimulus. Second, government debt levels. US federal debt now exceeds $34 trillion. Servicing that debt becomes more expensive when interest rates rise. Long-term fiscal deficits contribute to structural pressure on currency value. Third, structural inflation shifts. Housing, healthcare, insurance, and education costs have grown faster than headline inflation over long periods. Even when inflation slows, price levels rarely reverse meaningfully. Fourth, global realignment. Some countries have increased gold reserves and reduced reliance on dollar-based trade settlement systems. While the dollar remains dominant, diversification efforts globally have increased. Again, this is not collapse language. It is structural reality. Currencies slowly lose value over decades. That is how fiat systems function. The key is understanding how to respond intelligently. The biggest mistake is confusing safety with stability. Cash feels safe because the number does not fluctuate, but stability of digits does not mean stability of purchasing power. If inflation averages 3% and your savings account earns 2%, you are losing 1% of purchasing power annually. That loss compounds. Over 10 years, that gap becomes significant. Emergency funds absolutely belong in liquid cash accounts. However, long-term savings meant for retirement or wealth building require growth mechanisms that outpace inflation. Otherwise, the erosion becomes permanent. Historically, investors have used several approaches to protect against dollar erosion. Equities have historically outpaced inflation over long periods because businesses adjust prices and grow earnings. Real estate has provided inflation hedging through rental income and property appreciation. Gold has served as a store of value during periods of currency uncertainty. Over the last 2 decades, gold has risen significantly during major monetary expansion cycles. Diversification across asset classes reduces dependence on any single currency dynamic. However, all of these assets experience volatility. The objective is not to eliminate fluctuation. The objective is to preserve and grow purchasing power over time. That requires structure. It requires risk management. It requires adaptability.
In inflationary and volatile environments, static strategies can struggle. Markets no longer move in smooth, multi-year cycles. Volatility spikes more frequently. This is where structured, rules-based systems can play a role within a diversified portfolio. Inside Automated Trading Network, clients operate through their own regulated investment accounts. They maintain full control of deposits and withdrawals. The technology has permission to execute trades, but it does not take custody of funds. The system operates with predefined risk parameters, such as position sizing controls, exposure limits, and drawdown management. The objective is not to predict currency movements. It is to adapt to changing market conditions while maintaining disciplined risk management. In environments where inflation erodes cash and volatility challenges traditional allocations, adaptability becomes valuable. Automation does not remove risk. It enforces discipline. And discipline becomes increasingly important during uncertain monetary cycles. If you are concerned about dollar erosion, here are practical considerations. Maintain sufficient liquid reserves for emergencies. Avoid excessive idle cash beyond short-term needs. Diversify across growth-oriented assets that historically outpace inflation. Consider assets that benefit from monetary expansion cycles. Evaluate whether part of your portfolio uses structured, risk-managed systems that adapt to volatility. Most importantly, think in terms of purchasing power, not just account balance. A larger number does not always mean greater wealth if costs are rising faster. Protection is not about reacting emotionally to headlines. It is about designing a portfolio that survives multiple economic cycles. The dollar is not disappearing, but its purchasing power will continue to evolve over time, as it always has. The goal is not fear. The goal is preparation. At Automated Trading Network, the focus is on disciplined execution inside your own regulated investment account, where you remain in control of your capital and technology operates within defined risk boundaries. If you would like to explore how structured automation can complement a broader strategy designed to protect purchasing power, you can review the details through the link in the description. Take your time, study the structure, make informed decisions. And if this breakdown helped you better understand how currency value impacts long-term savings, consider subscribing and turning on notifications. This channel is built for investors who value clarity, discipline, and long-term financial resilience. I will see you in the next video.